might add a little bit to that position after this call.
With InfiniFi on our liquid side, you're getting access to higher returns than you'll be able to get in Morpho, Aave, or any of the other liquid assets.
You want to maximize your points, the IUSD YT might be the most interesting choice here.
It definitely is. It's just been genuine organic demand for our product that has shown up off the street. I don't know who half those people are.
One thing that I always find underrated in DeFi is that most of the people lose, especially in stablecoin forming. So much money is lost due to slippage, due to swapping costs, due to bridging costs.
IUSD was not really originally planned, but as we started looking into the mechanics, it just seemed like a very natural thing to do.
Matching the most appropriate yields to the corresponding preference.
You can't create risk, you can't create returns, you can only rearrange them, and that's what we're doing.
GM, and welcome back to this interview on the Odyssey podcast. We are joined by Rob from InfiniFi. Rob, how are you doing?
I am doing fantastic, Max. It is great to be here. It's been a fun few weeks since we launched, and yeah, just been running around, talking to people, and getting more partnerships lined up, and watching our TVL grow up past 45 million.
Absolutely. I think, in my personal opinion, InfiniFi is one of the most exciting DeFi protocols out there. So we'll discuss everything from its origination story, how Rob ended up in this place, to the path of the product of InfiniFi, how they developed it, how they distributed it, and the pretty impressive growth of the TVL just having launched a few weeks ago, and what's ahead for the fractional reserve landscape in DeFi. So yeah, let's jump right in. How did you end up here, Rob? What's your?
That's a long story. Winding, twisting, going all up, down, left, right. Starts in 2013. Really starts in 2011. Probably even further back. I've been interested in computers my entire life. Always wanted to know how to program. And in 2011, I taught myself to code by ripping apart Minecraft, of all things, and writing a mod. And got really deep into Minecraft as a result of this. Ended up on an Anarchy server, hanging out there in 2013.
Ayn Rand sends her regards.
Goddamn right. And Kappa stands. Good stuff. It's called Civcraft. Some people out here remember Civcraft, and that shit was wild. Like you had on one server, just digress, tiny aside, you had a bunch of ANCAPs, minarchists, ANCOMs, which were basically anarcho-communists, actual communists, and eventually you had an invasion of basically like pseudo-fascists, which was just incredibly entertaining, probably some of the best reality I've ever seen in my life. You could have made a TV show out of this fucking thing.
But I believe that. That.
The drama in the Minecraft story, hey, good drama. Anyways, I digress. I got told about this.
Worse drama than in the Cosmos ecosystem, and that's where to beat.
Jesus Christ. Yeah, Cosmos, man. Getting there, actually. Got told about this thing called Bitcoin. Thought it was pretty cool. Looked into it, realized it was the next form of money, and bought two of them. Lost one to Mt. Gox, spent the other on a fake ID, but I had the bug. And, mined Ethereum all through the 20s. Starting 2016, mined Ethereum. But, I was playing crypto forever. So, come 2021, I was getting married. I did not enjoy my job. I was a doctoral student in nanothermal engineering. And I wanted to, be able to pay for my honeymoon. So I'm like, hey, what's going on in crypto? Start a validator on a Cosmos fork. Funny you mentioned it again. As it turns out that the Cosmos fork, unification, guy who founded it, is probably Ryoshi, which is why it blew up the way that it did. Just money getting kicked back from Sheeb. But made a lot of money on that. Went from zero to the number one validator on the network in a few weeks because I was offering people kickbacks and no one else was offering them kickbacks from the revenue they were making. I realized I could actually, do stuff here. I think I made 3 times my annual salary in the span of like 6 to 8 weeks. It was incredible. You can just do things. Went out, taught myself to code Solidity to build an NFT project, launched an NFT project. generative NFT project at a time when that was pretty rare, and had a lot of fun with that. Started my first company, Revest. We launched that in September 21 and went through all sorts of craziness and drama with Revest. Had the original team try to take it apart for scrap, got hacked, rebuilt the team, rebuilt the product, launched another product, struggled to find PMF, thought we'd found PMF, and the token came back to life. That was pretty cool. We moved on to some new stuff, started playing around with a few new ideas, and one of those ideas was InfiniFi. We stumbled upon it almost by accident when somebody was asking us, hey, can you make these, illiquid assets a bit more liquid? Is that possible? Um, the Centaurus guys, formerly Into the Block, they liked what we had on offer, but they couldn't touch it because they had a liquidity mandate. So I took a spreadsheet and I started playing with maturity tranche and a fractional reserve element. And I took inspiration from a few things I'd seen people try. Chief among them was actually Beefy, of all things. They had a Velodrome VE NFT liquid locker years ago that didn't quite work because it was fractional reserve and on a 4-year time horizon. It's kind of a prototype of usual, actually, come to think of it. But it gave me the idea of, hey, let's try fractional reserve here. And it worked. Suddenly, everyone was making more money with the addition of the maturity tranche. And that was impressive because everyone was making more money. So once I figured out that part, it's like, what the hell is this thing? Did some digging. Oh, I've just reinvented fractional reserve banking with a brand new formulation.
So for the non-DeFi native crowd in the audience, can you briefly explain the concept of fractional reserve and how InfiniFi works?
I saw an article yesterday by Nansen, and they described it as borrow short, lend long, which is what we do. You deposit liquid capital to our system, as there's two types of depositors, liquid and duration. On the liquid side, if you deposit liquid capital, we're going to take, 25% of your capital and put into liquid assets, but the remaining 75% we're going to pipe over into duration assets, things like PT tokens. And since PT tokens have a duration associated with them, they're yielding a higher return than the liquid asset would correspondingly yield. And since we've got more money in duration assets, the total return that we're earning is higher. Now, how do we know which duration assets to go with? Well, that's where the other depositors, our duration depositors, come in. They indicate, hey, when I ask for my money back, I want to wait 1 week all the way up to 13 weeks to get my money back from you after I ask for it. They earn yield all the while that they're waiting to get it back. A lot of people get confused by that. It's not like Athena. There is no dead time. You're earning yield the entire time you're leaving my system. And what that means is that we now know what the preferences are. How many people want, 13-week liquidity? How many people want 1-week liquidity? What's the proportionality between those two? And that information, we pay a premium to those depositors for it. But that information guides us into what duration assets we should be deploying into, like how much, 12-week, 13-week PTs versus 1 week, 2-week, 3-week, 4-week PTs should we be holding. And that allows us to automate the laddering of our portfolio to make sure that we have capital coming due on a consistent basis. And since these guys are providing useful information to us, like I said, we pay them a premium. And how do we pay them a premium? How do we pay them above what they would otherwise be getting in Pendle itself? We take some of the money that our liquid depositors have given us, and some of the interest that it's earned from being in duration assets, we give it to them. So
So
rather than
the
getting
logical follow-on question from that would be, why would anybody deposit in the liquid tranche if they know, okay, the yield of those who are willing to lock their assets up is coming from my money as a liquid depositor? Why would I deposit into this?
because they're still getting higher returns than they otherwise would, and they can leave whenever they want. They don't have to wait. So they're giving, and also, well, there's also the risk element. But let's start from before we start talking senior junior. Let's talk about the demand element. Having capital availability instantaneously is a mandate that a lot of participants in this space have, and some of them can't even lock for 1 week. Being able to access immediate entry exit returns is very useful. as we see with things like Aave, for instance. Otherwise, everyone would be in PTs, not in Aave, not in Morpho, not lending through those. People like having that ability to exit immediately. So with InfiniFi on our liquid side, you're getting access to higher returns than you'll be able to get in Morpho, Aave, or any of the other liquid assets. Since you're still earning, those returns from your assets that have been deployed to PTs, you're still making a higher yield than you would in normal liquid assets. You're not making as high as you would in a PT, but you still get that exposure. And because you're in the senior tranche, it's the other part of this answer, you are insured against any of the risks that those assets might otherwise carry by the duration depositors who represent the junior tranche. They take first loss. So you are getting the benefits of these high return assets without the primary drawbacks of illiquidity and potentially higher risk.
So essentially, you're not doing any magic or innovation on the yield generation side of things. It's purely an innovation on the duration risks and spreading that by having a large pool of capital with different depositors who all have different preferences and just sort of matching the most appropriate yields to the corresponding preference.
You can't create risk, you can't create returns, you can only rearrange them. And that's what we're doing. We're just changing the flows and, changing the risks. And obviously, none of this comes without a cost. On the duration side, your primary risk is that concentration risk, your first loss. If there's a 10% loss, you might end up taking 20, 30% loss because you're taking losses on somebody else's money as well as your own.
What's the scenario where that loss could come to be? So would that be that one of the PTs you bought is not backed fully? Let's say, for example, I think yesterday or 2 days ago, there were some
The Falcon
panic
stuff,
about the Falcon stable backing.
yeah,
Would that, for example, be a scenario that could hit you?
yeah, it could. I'm glad we're not in Falcon. Actually, we looked at their system, decided this is way too opaque, and passed them over for that exact reason. But yes, in the event that there was a failure in the backing of the PT, if the PT itself, like if somehow Pendle got compromised, don't even think that's possible, but I suppose, anything is possible. Any of those two, if we got compromised, there's a third one, any of those three could cause a loss in the value that backs those assets. Any of those three would result in a loss to our junior tranche.
Just to understand the flows a little better. So as a depositor, can you just deposit liquid USDC and then it's all kind of managed as one pool across these different durations? And how does the exiting look like? Because one thing that I always find underrated in DeFi is that most of the people lose, especially in stablecoin farming, where you're trying to get, let's say, between 10 to 20% a year APR. So much money is lost due to slippage, due to swapping costs, due to bridging costs. So yeah, how do we flows for InfiniFi work?
Yeah. So all of our liquid assets are fully denominated. Okay. So simple. It's USDC in, USDC out. So we handle all the execution cost, all the execution side of things, mostly through CowSwap, actually, when we're talking about, well, a certain variety of assets. But all of our liquid assets are one-to-one USDC backed. There is no asset in the liquid side that has anything to do with slippage. On the illiquid side, you're going to have some assets that are not fully USDC backed. And in that case, what's happening is we have a buffer that absorbs the slippage on entry and are in the process of working out certain agreements to ensure that any fees on those assets will be treated in a very certain manner. Can't say anything more until those deals are done, but I am working to consistently offset those execution costs by
Pretty cool, because
revenue.
that was something I was wondering about. Like, do you have to manually swap these, manage these, or is it all automated? And how do you optimize for minimizing slippage, gas fees,
So
entry exit fees,
yeah,
etc.?
right now it's controlled by an off-chain system. What happens is our system calculates, hey, I know that these are the parameters that when you deposit, it all goes into liquid. Every 8 hours or so, our rebalancer triggers and uses a combination of the on-chain votes and an off-chain algorithm to align the votes to, follow certain constraints. Like you can't put 100% of assets in 13 week if there's no voting on 13 week. And it relays this information on chain and tells our system, hey, move this USDC from the liquid farms into this, say, SUSDE cow swap farm. And the USDC sits there, and our off-chain farm swapper checks, hey, how much can I rebalance from in here? Actually, no, it triggers a limit order. Says, hey, I want to swap X amount of USDC into SUSDE, and I want to do it at this limit on slippage. And if it can't get filled, it doesn't get filled. It then keeps trying to do that for the next hour or two, and after a certain amount of time, these things they typically get filled. So
So
we're
you'd
able to.
rather miss out on a little bit of yield than risking any principal loss through slippage.
Yes, we have extremely strict limitations on how much can be swapped and when it can be swapped. I think actually, if we don't think that, so cow swap's a bit harder since limit orders are limit orders. 99% of the time with SUSD gets filled immediately. So very easy on that side. On Pendle, we don't even trigger the rebalance if the system doesn't think that it can move this much capital without incurring losses above a certain threshold. Like if it thinks, put it this way, if we were supposed to deploy $1 million into PT Syrup USDC, and our system runs its calculations, simulates the transaction, and it says, oh, if I'm going to respect my slippage maximum, I can only move $750,000. Well, then what will happen is our system will only move $750,000. It'll leave that remaining $250,000 sitting in liquid assets right until the next rebalance cycle, so that it can achieve its desired outcome and not cause large slippage on that pool.
I think that's tremendously important to pay more attention to that. And I'm personally pretty glad that you're doing this, because it's such a, like, people look at these APRs, often only APYs are advertised, which already assume continuous compounding, which often, or like 99% of cases, is not the case. But yeah, I think it's pretty cool that you're optimizing for these hidden execution costs.
Thanks. We
Yeah,
have. Can I talk about the J curve real quick?
sure.
Because I love talking about the J curve. You'll nerd out on this too. So our front end, actually, the APY it shows is I think around 14%. If you go to DeFi Llama, you'll see that our current APRs are actually right now only around, I think, 11.5. And you're gonna wonder, is Rob, full of shit? Is he lying to me? No, I'm not. What I'm actually doing is doing this exact sort of slippage engineering we're talking about. With a PT, especially an SUSD PT, you have the potential at the end of that period that you have to swap from SUSDE back into USDC. Now, like I said, I'm engineering a few things to cut down on those execution costs dramatically and over time. So time transform that slippage into a different form of, rent entirely. But I have to engineer it from a worst case scenario standpoint. So what we do is when we swap in, even though we expect that at the end of that, we actually can just take that SUSDE that we get from the PT and roll it over into the next PT SUSDE rather than having to sell it for USDC, we still set aside 20 bips of slippage as a buffer. Let's say that we earned 8% on that. I think that's about the average. Okay, now we linearly interpolate a zero linearly to how much we're going to receive at maturity. And that's how the interest accrues. But then at the very end, assuming that we don't take any slippage, there's a vertical offset that we realize right there in the long tail. And that vertical offset is exactly why there's a discrepancy when you go look at DeFi Llama and the 7-day trending APR and what our front end projects. Interestingly enough, that DeFi Llama 7-day is going to also lie to you once that long tail comes in, because then it's going to be saying, 18, 22%, which is also wrong.
On the yield curve distribution side of things, so right now you only have a duration up to 13 weeks, which is, compared to TradFi, pretty low. Also, when I noticed between the different durations, like usually it kind of feels like an inverted, but not necessarily an inverted, but like a very slowly increasing yield curve. Like people demand less and less marginally more yield the more they go up with duration. How do you think that comes to be? Because intuitively, one would think, okay, DeFi is such a fast moving space, such a risky space. I would want to have exponentially more yield if I'm willing to lock up my funds for 13 weeks, for example, compared to 8 weeks.
It's really strange. I think it's going to continue growing longer tail, especially in the next year or two. We did we chose 13 weeks because we did an analysis. I sat there with chat with Cursor and Claude and worked on just pulling all the data from Pendle for literally like hours and then visualizing that data. What I found was that the yield curve in crypto over a 6 month time span, which is about as long as PTs get, it goes up and then it actually slopes down. It becomes negative after about 13 weeks for some reason. And I don't know why that is. I think people in this space just really don't have the attention span for anything longer than about 3 months. And because of the market forces, there's just a desire to not be in any asset for longer than a quarter. You also have the funds themselves that cause this. In TradFi, you've got that institutional time preference of, much longer than 3 months. You got 30-year time preferences in TradFi since these institutions have been around for so damn long. They think much slower and they act much slower. But here, our institutions are all hedge funds. They have, much shorter redemption periods. 3 months is an eternity for them. 1 month is actually the most common. When you really start to talk to these guys, you figure out, yeah, they don't have the ability to hold assets on their books for really longer than a month, by and large. Some of them can do 3 months. I don't know any of them who can do beyond that. I think that especially is shaping a lot of these effects because there's just no market for it. And because there's no market for it, it slopes negative.
That's pretty interesting. Do you think that is going to like? Do you personally view this trend as an inefficiency, and do you foresee it to change, or like are there specific conditions where you would say, okay, XYZ needs to be fulfilled before this changes, otherwise it will just continue that way?
I think it's going to change, especially as we see more RWA capital coming on chain and as we see more traditional funds showing up in the space. Because right now, like I said, we're limited by the biggest money participants here having these constraints placed on them because that's what they said out of the rip. And they can only change their funds so much. Their LPs have come to expect this sort of redemption period. But as we see more mature financial entities showing up in the space, I do think that changes. I think we start to see initially it's going to show up as kind of a grafting of two curves. You're going to have, the DeFi curve here where it's just peters out beyond 3 months. And then you're going to have, and you're already starting to see them, RWA protocols grafting their own curves on, which are actually much better beyond 3 months. If you talk to the RE guys, they're doing 15, 16%, but it's an 18-month time horizon. I've seen a lot of SPVs with 18-month time horizons. And based on that, what I'm kind of figuring out is, yeah, that's actually probably the shortest tail of TradFi is about 12 to 18 months. I don't know what's going to fill the middle. Probably people decomposing the longer term SPVs into shorter duration assets. I myself am currently trying to work on a few deals to do that. But yeah, as you see more RWAs flow on chains, you see more RWA oriented funds flow on chain with their RWA oriented yield curves. Absolutely. It's going to change. It's just a matter of, working both sides of that and slowly bridging that gap until they fully converge.
On the side of the yield generation, so as I've understood it, you're mostly exposed to Pendle PTs, right? So it's essentially publicly available yields. Are you also looking into private liquidity deals, or what is currently happening in the yield generation landscape?
So I'm looking into private liquidity deals. I'm a bit wary just because I have, I've worked in that industry myself. I know how those deals are structured. when we were, getting ready for launch, I had plenty of funds asking me, hey, can you guarantee us 30, 35%? If you do, we'll give you liquidity. I turned every single one of those funds down because that's insane. You should not be guaranteeing 30 to 35% APR by printing tokens. That's the additional context here. They expect you to print tokens at whatever FDV you launch at to bring them to 30 to 35% on, say, 10 million. So you're forced into a position where you're going to turbo dump on retail if you agree to those terms. And that to me is a bit of a suicide pact. I think there's definitely interesting stuff in the private LP deals. I think that since those deals are typically valued at the FDV at launch, a lot of those people are going to end up with significantly less than they expect that they're going to get. And that's a huge problem. I know some people who are doing really good work in aggregating those deals. To be honest, I would rather put money into them and let them do the aggregation for me than really be the originator of that. I view myself as more of an allocator than an active manager. And so when I talk to guys like, for instance, take Stream Finance, I think they're pretty interesting. I'm looking into whether we can allocate to that. I need to be careful because, well, I think a lot of our trust and a lot of our success so far is not because we are the single highest return. If you compare us to Stream, if you compare us to something like EtherFi's delta neutral vault that does leveraged looping, well, we're not. We can fit in really well as a building block for those things, though. And that to me is exciting. That to me is very interesting because that gives a lot more size and a lot more. Not having internalized leverage allows me a lot more flexibility in what I can be integrated into than if I internalize the leverage myself. So, yes, I am curious about private liquidity deals. Typically, just because those are brand new protocols, I would honestly prefer to deploy to somebody who is doing diligence on them as their full-time job and who has the expertise necessary to say, hey, this deal is actually going to definitely pay out at this rate, or no, this is complete bullshit. This is going to blow up all over the place and cause some serious problems for everybody, including the people who took the private liquidity deal. Falcon's actually a great example of this. I don't know if those allegations are true. I haven't seen the details myself. I do know OX Law, the guy who made the allegations. Pretty good dude. Got some really random connections to him. But the allegation of 40%, if true, that's honestly the most concerning thing because they're going to print their token out of existence when it comes to market. This is the newest version of high float, low float, high FDV, and it's not real. Because these funds who put money into this, they expect you to just print token, print token, print token, and okay, you say it doesn't sound too bad until you now realize if you're talking about guaranteeing 30% on 10 million, you're talking about 3% of your token supply at 100 million FDV. Guaranteed dumped within 6 months. What's your airdrop? 5 to 10%? You do that for, $30 million, you have just dumped your entire airdrop and cratered your value. I believe by 75%. It's a mess and it's not sustainable. And yeah, now there are some that are good. There are some that are good. Don't get me wrong. Yeah. But you gotta be good yourself to be able to pick out the wheat from the chaff.
No, 100%. Maybe on the note of incentivization with points, with tokens, with any kinds of emissions, what have you learned from the ones that have happened in the last year and a half? Let's think Eigenlayer, EtherFi, Ifina, all of these models, because you guys have a points program going on right now. So, like, what have you learned from these past iterations, and how have you adapted?
Pendle. Just had to quote the Twitter post. Anyways, yeah, you want to take good care of people. You don't want to pull bullshit on them. I think who was it? Was it Eigen who did that thing with the YTs? That was awful. You should treat YT holders, honestly. They're paying for leverage on you. That's a good thing. They should benefit from paying for leverage on you. It should be linear. So that was one of the biggest takeaways was, don't screw people. Don't go in and make weird adjustments just because. I myself hold $10,000 worth of YTs solely so that, well, one, because I happen to know that it's a good deal that I got, and two, because it's incentive alignment. And I could tell people that, and they know, okay, yeah, he's not going to screw us because he'd screw himself. And yes, I would screw myself. Those are the only token. Well, I can't talk about anything related to the point system. Sorry. There is, I don't know what you mean, token or airdrop. No idea.
We are not U.S. citizens here.
Obviously not. Definitely don't sound like an American. But yes, the the whole thing, treat people fairly, I would say is the big one. Um, I learned a lot from sitting down talking with Steven and Mara about, multipliers. That was really helpful getting their input on that because we were about to go out with some multipliers that were probably way too high and we dialed them back. Um, Another one, Open Eden taught me you always want to incentivize the full notional value of the LP. They did so good on that. They were the first ones to do it. That's why they're as big as they are. It worked great. People have been gobbling up that token. They have just they love it. So I'd also say you want to okay, there's two more things. One, social stuff is useless. People like it. It's kind of cool. If you're gonna do it, you got to do it in a way that you prevent Sybils. Otherwise, you'll just get Sybil to hell. I've seen that happen 1,000 times. It doesn't add value. You want people to use your product. That is your goal with any points program: is bootstrap the actual system, not get a bunch of followers on Twitter. Followers on Twitter do not convert to money.
So no Galaxy campaigns and no Kaido yaps.
No,
Thank God. Thank God.
no, not in 1,000 years. I did notice actually. This is hey, I know Win Moon's cool. Kaido's interesting, but I'm not going to pay him for it. I have been getting free Kaido though, because so first it was Infinex, and Infinex sounds kind of similar to InfiniFi, so we kept getting tagged by people on Infinex on the Kaito campaign. And now Infinite has launched their own Kaito campaign, and we keep getting tagged by people on the Infinite campaign. So I haven't paid anything, and I'm getting free apps. It's great. You know what those things, the Kaito cost. So like,
Yeah. No, I think the whole concept of Kaido, I mean, it certainly has some sort of product market fit, but I mean, it's one of these very typical cases where as soon as you launch something that can be gamed, it will be gamed, and the kind of downstream effects on the quality of crypto Twitter content is just obnoxious. I mean, all of these pseudo alpha analysis research accounts kind of centering their entire growth story on these are the current Kaido campaigns you can farm. I mean, what kind of low IQ individual do you have to be to see this content and then think, yeah, this is genuine research being done there? It doesn't make any sense.
it's insane. These people are literally just like, you are the product. They are openly telling you that you are the product. They're getting paid to. They're just like, yeah, we're getting paid. You like the content?
I mean, on the positive side of things, it will probably weed out a lot of low quality KOL accounts, which I think. I mean, crypto Twitter. Sorry for the tangent here, but the quality and the sentiment there has declined quite a bit over the last, let's say, 6 months at least, and I do think that it's. I mean, one of the value propositions of Kaido is going to be to just filter out genuine versus paid and rather low quality KOLs.
Yeah, I definitely don't miss some of the dog shit accounts, pretending that they're actually interested in a project only because they're getting paid by it. It's lower quality. It's honestly slightly less annoying than it was in late 23, early 24, when you had all the pump fund people talking about, that dog shit. At least now it's actually talking about DeFi instead of, the latest dog coin
Yeah.
or some other stupidity. But yes, I won't miss those accounts somehow getting much larger than they should. The next Ansem is already, he's selling out to Kaito.
Absolutely. Coming back to the voting mechanisms, so how exactly is the yield distribution between these different tranches determined? Is it just a function of how many people deploy into these individual tranches, and what's the role of IUSD?
So it's determined by a set of multipliers that we, the team, are currently setting. Eventually, they'll be democratized. Basically, we try to look at what's the relationship between an asset that's 1 week and an asset that's 13 weeks. What's the yield differential there? What's the premium? Once you adjust for ROI, not APR, because actually Is it APR? I can't remember. Either way, you have to normalize them. We look at what that differential is, and then that helps to determine the multipliers within the duration assets. And then we look at what the relationship of the best earning liquid assets are relative to the 1 week assets. And that relationship helps us determine what that multiplier should look like, what that balance should look like. We haven't updated that in 4 weeks now. I think we had to update it right around launch because it was just off and the duration depositors were getting way too much. But most of the time, it's just us going in there, tweaking that. And those multipliers are multiplied by the deposit sizes in each tranche. So 1 week times, the number of people in there. And then we just kind of sum those things together. So if liquid is 1x multiplier, there's 15 million, liquid would be 15 million power. If, say, let's just say there's only one tranche, 1 week, and 1 week has 7.5 million, but the multiplier is 2, we do 2 times 7.5, also 15. So we look at the total interest coming in from all assets, liquid and illiquid. We'd say, hey, 15 over 30. Okay, it's just a two-way split to each one. And that's how it works. It's a bit more, complex as you generalize it out to the other ones, but at the end of the day, it's that simple.
So what's the role of IUSD? Is that how does it play into the flows? How does it play into the entire InfiniFi ecosystem? Because I've seen you can also use that itself on Pendle, right?
Yes. IUSD is the super senior tranche. It is insured by SIUSD, the staked version, which earns yield. IUSD was not really originally planned, but as we started looking into the mechanics, it just seemed like a very natural thing to do. Frax has it, Athena has it. Frax, so Frax USD, SFrax USD, SUSDE, USDE, and it's just a one-to-one stablecoin. It doesn't earn yield. Technically, actually passes the Genghis Act consideration because of that. It is redeemable for USDC at any point in time. It has the nice little side effect that its existence subsidizes everyone else. So because we have a decent amount of it on Pendle, and that's why we went with it as Pendle, just get the yields a little bit higher. So why not? Uh, Thanks to that capital on Pendle, I think there's like 15 million there. The remainder of our system is being boosted by probably about 33%, I think. Higher than it would be just because we have that extra IUSD that's not earning any yield. And all the yield that it's earning is going to SIUSD and the locked IUSD, LIUSD positions. So its role originally was, hey, we need an actual stable coin for our AMMs to work on. Since some parts of Curve do not like if you're trying to use a vault token, it fucks with the balancing. You end up basically paying the AMM money if it's a rebasing stable and it's just lost capital. The Origin guys told us that just do not do a rebasing token. They're awful. So yeah, it was originally just designed as a technical workaround, and then it turned out that it had the happy little accident of also subsidizing everybody else.
So right now on Pendle you get close to 9% on the PT. Where is that yield coming from? And do the YTs of IUSD also earn points? Or like where's the demand for the YT side coming from?
Yeah, so we do 2x on IUSD because we want more people subsidizing that yield. It's a beneficial thing for our system. With Pendle, we wanted to give even more. And so if you're in YT, you're getting the leverage that you would normally get on the IUSD. It's earning at it's not earning 2x points here, it's earning 4.5x. You are getting that leverage times that 4x, which actually makes like X points on the YTs right now.
So without leaking too much alpha here, but if you are bullish on InfiniFi as a project and you want to maximize your points, the IUSD YT might be the most interesting choice here.
It definitely is. That's why I have $10,000 in it. Because I saw Steven's math, I saw our own math, and Steven confirmed our own math. Well, okay, his estimate was a little different, but about the same. It's a decent number. You can go read his thread. I can't say it on air because that would imply the existence of a token, but it's good. It's very good.
Very cool. Might add a little bit to that position after this call because I mean I try to be as as critical with my questions as possible. But I mean, it's hard to draw anything where you don't have a good answer to be frank. So pretty
It's a good
excited about
product.
InfiniFi.
It's a very easy thing to sell because it actually does something.
The devs did something. Maybe to dive a little deeper into the growth story, because I mean, it's not the usual path that, I mean, you didn't start out with a huge personal brand, or like any insane amount of capital. How did you manage to grow your protocol to 45 million in TVL in such a short time? Like, what are your BD and growth strategies there? How did you achieve that?
Yeah. So we had a small amount of bootstrapping that we arranged ahead. Like I said, we rejected anything that required us to hit a guaranteed APR. I am not interested in those sorts of deals. Those deals are evil. We actually did a very innovative strategy where we basically said, hey, you go farm the points program like everyone else. And if you hit a target, cool, we're not going to pay you anything. If you don't hit that target, we'll make sure you hit that target. And much better incentive aligned. So we set that up to give us about 12, 13 million that's been bled in there. The rest of that's just been integrations. It's just been genuine organic demand for our product that has shown up off the street. I don't know who half those people are. I'm trying to find out who they are, but I couldn't tell you entirely where each one comes from. I think that we had Pendle lined up at the start was a really big bonus.
Yeah, that's a pretty big unlock. I mean, given that Pendle, arguably, along with Morpho and Fluid, these are on the DeFi native side, I guess the three most successful protocols of the last 2 years. It's pretty impressive that you managed to have an integration there so early on.
Yeah, and thank you. Thank you. I appreciate that. We've been building this space for a while. We knew them. We had good BD. Um, we were talking to them for months ahead of launch, just like, hey, we really want to, work with you guys. This actually works really well for Pendle. And they're like, oh wow, this does work really well for Pendle. Since a lot of their LPs hate having to roll over their PT positions. And one of the benefits of InfiniFi that I always forget to talk about is it automates your rollovers. You don't have to ever do that again. You deposit whatever duration you're comfortable with, and you just get PT yields forever without having to actually go in and touch the PTs. It's very convenient for our users that way.
On the PT yield side of things, so if you decide to, just one important thing to note for potential depositors is that if you lock your assets for a given duration, this yield is not fixed, right? It can vary. So it's not the exact same as buying a PT.
Yes and no. There's a fixed and a floating component to it. If you deposit now, yeah, it's a summation of your current state, the past state that happened already, and how that's being linearly interpolated, and what the future state of linear interpolation is. Like right now, I think we're actually earning our APRs on Syrup are actually above what you could get on Pendle because we already bought them and they're being linearly interpolated over the duration of that asset. And now, yeah, I'm sure someone could actually do a derivation and show that it does eventually collapse down to some sort of a fixed plus a floating element, but that's beyond my mathematical ability.
I mean, just the TLDR for users is that it's not the exact same as a PT, but the truly variable portion of the yield is comparably small.
Yep, exactly. So you should be seeing basically a very similar return profile to a PT. Especially if you were DCAing into that PT over time, your return profile is going to look nearly identical to that.
So, given how many interactions you've had with the liquid fund side of things in DeFi, and probably, I guess, the bulk of your users are either small institutions or pro-tail people. So, actually, the ones who make up a large portion of the DeFi activity, the very few hundred people who actually use that stuff. What trends do you see in that crowd, and like how does that inform your outlook on the DeFi landscape as a whole?
Leverage looping. Everyone loves to lever their PTs. And this is actually where we're going with InfiniFi. So, I mean, the partnership with Athena, huge. Partnership with Pendle, huge. They've opened a lot of doors for us, especially on our phase 2 RWA prospects. What we're angling at right now, though, is we want to help Pendle to get even bigger. I want to help Athena to get even bigger. And we want to make the leverage loops that people are able to currently run even more efficient. This is where I see so many people operating right now is this Morpho Ave Euler paradigm where they,
100%.
yeah,
Like when I mean, we are both pretty active in the DeFi dojo. It has pretty much every single DeFi strategy right now has collapsed down to looping of some sort. Maybe for the non DeFi native folks, could you briefly explain like what leverage looping is and how it applies to PTs?
yeah, especially with PTs, it's probably one of the safest forms of leverage because what you're doing is you're taking the PT, which is often backed by USDC, and you are then taking that to Morpho, depositing it as collateral into a Morpho market, and borrowing USDC against it at a fairly low health factor or fairly, decent health factor. You get a little bit of buffer in there. Since those two are both pegged to a dollar, they don't really fluctuate too much. And that means that the position is quite safe. You then take the USDC, you go purchase more of that PT, and then you bring it back to Morpho. The yield at maturity of that PT is going to be typically higher than what you are seeing on Morpho. That is to say, if the PT has a yield at maturity of 8%, and the Morpho bar rate is 6, you've got a 2% spread there. And if you run that loop enough, you're going to be sitting, 20, 40, even 60% is not entirely unheard of because you're just stacking those returns and restacking that spread.
And just to expand on the discrepancy there, so essentially the lower borrow costs on USDC comes to be because USDC is a vanilla stable. There's a lot of that in circulation, and people are willing to settle for a lower yield lending out USDC than the acquirers of these PTs demand.
Also, a far more passive position. Yeah,
Yeah.
it's higher risk and higher effort to run these loops versus just letting into Morpho and not having to think about it. Kind of like IUSD on the liquid side is safer and more straightforward than IUSD on the locked side. General concept. But where we see ourselves in this, Max, where we're angling, is we want to become the asset that people are looping. Instead of running a PT loop where you got to, go out, borrow against that PT, run that loop, 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 where you have, the PTs are only earning 8 and the borrow is at 6. If you take LIUSD and LIUSD is earning about 12.5 and the borrow is still at 6, you have a lot more spread there. You're still backed by the same PTs, but because of how our system is structured, you are now earning a higher rate of return on that LIUSD while having similar collaterals that back it. Your risk profile is quite similar, but you have a much larger spread
Yeah.
because you are taking on that first loss risk. You are taking on that concentration risk. So now you go out and you can spin up this loop and you're getting a bigger amount of money out of the loop. So you're making a higher return. The borrowers, the lenders on that loop, they're making a higher return since, you're driving their borrow up past 6 and utilizing it more. But by the time those two start to converge, there's still more juice. They're sitting at like 8 or 9. You're still making probably 80 to 100%. I actually haven't run the maths. It's pretty big. Um, so you're sitting an extreme chunk of change on that. And you end up also not having to constantly unwind and rewind that loop with the PTs reaching expiry like you do in conventional leverage looping. This
Yeah.
becomes the kind of loop that you can just leave put on perpetuity because we're handling the rollover on our back end.
Yeah. Like personally, I mean, I would consider myself a fairly active DeFi user, and I hate the active management required for many of the looping strategies that are high yielding because you constantly have to monitor interest rates. And then sometimes it's a little bit hard to predict the true entry and exit costs due to slippage, due to gas fees, especially when I see people chasing loops that are going to sustain at max for a few weeks. I mean, many of them are not even profitable because they lose more to entry and exit costs than they make in fees. And on that note of everything kind of coming down to looping, do you see that any systematic risks are being built up in DeFi right now? Because if we ask ourselves the question, well, for all of these loops, where does the yield actually come from? So like, how does this discrepancy even come to be? And like right now, I see three main reasons for that. So the first ones is still kind of the speculation around tokens, around points, around airdrops. I mean, that's the one of the core reasons why people buy PTs, because on the other side, you have YT speculators who are wanting to get leveraged exposure to these points. So you kind of need a consistent influx of new protocols, of new hype, with new points programs, with new tokens. So you sustain that demand for the YTs, which in turn bids up the yield for the PTs. So one is the whole like token incentivization, token speculation factor. I think the second one is just the active and passive management sort of arbitrage you can do there. Forgot the third one now. I had them lined up really nicely a few minutes ago when
The other
we.
one, the private token deals.
No, not really. It was another one. So there's points and token speculation. There is just the passivity. Oh yeah, and then there's duration. So like, let's assume that you will increase the kind of ARB, but at the same time, like dilute the edge you can extract from duration. Because you're going to increase, assuming a success of InfiniFi, the yield that can be extraction due to duration matching these demands. Then let's kind of assume the whole points thing stays constant. And then on the other hand, you will also make it easier to outsource or automate the active management of these looping strategies, because you don't have to manually redeem the PTs, roll over into the next ones. You can do that all automated. So in the mid to long run, where do you think the sustainable yield sources in DeFi will come from?
I think that this loop, I mean, you have to assume that you have continuous entrance of new tokens. Yeah, that's accurate. Otherwise, you stop seeing the PTs get a premium. You stop seeing the YTs get a premium over the normal yield as easily, and that begins to collapse. And duration is no longer as useful as it was. You need new entrants with true duration assets. You are starting to see that through things like term max and term structure, who are all doing various different forms of term lending. And I think that will help because there is demand for more consistent rates. Are willing to pay a premium over, what might be looking at the liquid side just to avoid having that high volatility on rates. Some stuff's going to be helping there. You actually end up with a bit of a closed loop as we get into the mix. And I don't mean a closed loop as in everything unwinds. I mean more like the optimization almost closes in on itself and automatically fills any additional demand,
I
which
think
is
we are
very
still
nice.
quite far from that, because I would say that while in the grand scheme of things, the success of InfiniFi is going to decrease the edge you can exploit from duration matching right now, because nobody is doing it yet except for you, and there's still like a lot of capital to capture. I think until you reach the peak of kind of exploiting edge from duration matching, it's still like you still have a far way to go, and then it's going to like slowly decrease over time, and the more capital you are able to attract.
Exactly. And over a very long time horizon, you start seeing the borrow rates on Morpho approaching the rates that we're offering. And since we're profiting off that, you actually see a very interesting positive feedback loop start to emerge where we're deploying liquid capital to the very things that people are borrowing against us on. And it reaches a sort of meta stability. But that takes a very long time. And in the meantime, our advantage here is we can replace every single PT in every single, well, not every single, there are PTs that we won't touch just because they're just a little bit too risky. I don't want to touch too many things that already have leverage internalized their system since you're running leverage on leverage at that point. And that itself is systemic. But as we get deeper into it, I think we start to replace most of the existing PT leverage loops on Morpho with just LIUSD leverage loops. And then, as you said, yeah, over time you reach maximum optimality.
I think it's going to be pretty exciting how the DeFi still space is going to evolve, because, I mean, right now it's still frequented by a lot of unsophisticated players. I don't know if unsophisticated is the right word, but at least like, since it is introducing like a lot of game theoretic shenanigans and like incentive games, it's hard to look through all of them. So sometimes out of convenience, you'll just settle for a much lower yield, or some other people will fall for the promise of a very high yield, which then ends up not realizing. And of course, you can extract a lot of edge out of that by offering a more like streamlined and automated system. But yeah, I think we, as an sector on our own, DeFi needs to attract a net influx of capital. And I think, I mean, on the retail side, still the most impressive case for that, even though it ultimately failed, was Terra Luna with Anchor Protocol. Like nothing ever after that excited so many retail people to engage in DeFi. And this sort of very temporary success story has not been replicated yet. Of course, we all hope that it will not replicate on the way it ended. But yeah, I mean, DeFi on its own has matured quite a bit as an industry. Like personally, I think we are now finally at a stage where we have come past the food farm Ponzi's and just like playing vampire attacks on the sixth or seventh decks launched on some forked EVM L2, etc. And like we're
Oh no, I'm so
starting
sad
to,
those days are gone.
I mean, it was fun while it lasted because, I mean, for a very brief period of time, you could extract quite absurd yields from that. I mean, it's another debate how much of these yields then ended up realizing into cold hard cash. But I mean, it was interesting nevertheless to sort of speed run all of these Ponzi-esque incentive games. But yeah, finally we're at a point where we are maturing and also awakening the interests of the TradFi people and yeah, replicating some things from that landscape, improving on other things. And yeah, I think it's going to be interesting to see where we are headed. Maybe to finish off, what's the future outlook for InfiniFi? Are there any new features planned that you're about working on right now? Any
Yeah.
cross-chain deployments in terms of being able to deposit from other chains, or strategies that will be executed on chains other than Ethereum? And yeah, what can we expect in the near future?
So in the near future, I think I might have mentioned this already. Morpho vaults, LIUSD, Lin Borrow, SIUSD, Lin Borrow, more PTs. We don't have a PT for SIUSD. I'd like to have PT for SIUSD. We'll see what happens. Um, that's definitely the highest priority stuff right now. Cross train, interesting, not as high priority just because uh, I haven't seen too many. I haven't seen too much demand on for cross chain yet, especially for my community. And so, if I don't see the demand, I don't go there. I know Pendle's changed their cross chain strategy entirely. That's informed my interest because hey, they're moving to a hub and spoke model. Why are they doing that? They couldn't find liquidity out of their chains. That tells me that yeah, Ethereum remains the best place to be. Long term, this is where we really start to transform things. I'm working to get a POC set up on this. Uh, it's going to be very interesting once we get that thing going because in the current world of RWAs, and I mean, this is where it's all going. It's all going to the traditional finance. Traditional finance comes here. We go into traditional finance. We take over them. We push out the banks. We change what banks are. Banks change what we are, mind you. It's a synthesis, not a full realization of the antithesis, and not the full destruction of the thesis. It's the synthesis of the two. Um, we end up in a world where RWAs right now, and this is how InfiniFi fits in. RWAs right now, you pay a premium to come on chain. With InfiniFi, we pay you a premium to come on chain. That is the most succinct summarization of my vision that I have come up with so far. And what it means is with an RWA, you're currently paying to tokenize it. You're paying somebody to do the tokenization for you. That's an added cost, not an added benefit. Most of the added benefits are fairly niche for RWAs. Like, okay, leverage lifting, quite interesting, but still pretty niche. Requires you to have like a tokenized ETF. Doesn't work that well on AAA bonds unless they're in an ETF. But with InfiniFi, you can actually increase the returns on any asset, any duration asset. We've already seen it works for PTs. It works for RWAs as well. It works for bonds. And that means that if you have bond off chain at 5%, I can make it do 6. And that is interesting because that completely changes the incentive flow. Right now, you're losing money by coming on chain, but with me, you make money by coming on chain. And suddenly every single TradFi entity in the world, once I prove that this works, will have a reason to want to be on chain. That's the long view.
Pretty cool.
I'm really excited, man.
Me too. It's quite cool to see the space mature. I think some of it is a little bit, let's say, taking away the hopes and dreams that the space had, because the trend we are seeing right now is a lot of the value capture being taken by the fintech or by the TradFi side, because they have the existing distribution networks. They have legal enforceability, so they can provide a lot more security guarantees than DeFi native protocols can. So everything that comes to the tokenization of stocks, DeFi permissionless dream would have been okay. We are going to be the ones who will kind of eat the lunch of Robinhood. But right now it's kind of looking like it's vice versa. But I do think that there's ample opportunity left for DeFi to build something out and kind of take away TradFi's lunch. And yeah, I think that InfiniFi is one of the few protocols in the space who has a decent shot at that. So thanks for joining a lot, Rob. It was a great conversation. Any last words? Where can people find you? Where can people try out InfiniFi?
Yeah. To your point, we won't be the same, but neither will they. That's what synthesis is. It's when the thesis and the antithesis destroy each other and result in something completely new. And it won't be as perfect as the dream we had, but it'll still be better than what we got. So I'll take that. You can find us at infinifi.xyz or infinifi.org. Both are totally accurate domains. Let's see. If you haven't tried InfiniFi, come deposit some money, see what you think, see how the experience fits you. If you got questions, we are always hanging out in the Discord. Happy to answer them. Happy to dive deep. And thanks for watching.
It was great having you on, Rob. And maybe we'll be able to do a round 2 in some time.
Sounds like it. Thanks for having me.
Have a good one.
You as well.